Thanks for joining us today on The Close. I'm Marella Fernandez. Market close in a half hour's time. Let's get to the stories we're following in the BNN Bloomberg newsroom. The Prime Minister, Mark Carney, defended the Canadian oil sector today, speaking in Paris. He says Canadian oil is low risk compared to Venezuelan oil, which will help it remain competitive. In a social media post, the Conservative leader Pierre Poilievre is urging the Liberals to immediately approve a pipeline to the Pacific coast in case Venezuelan oil floods the market. Gold Reserve says it is seeking to regain control of its assets after the regime change in Venezuela. The mining company operated gold and copper deposits, which were seized by that country's government. In an interview with Bloomberg News, Gold Reserve says it is already exploring deals that could help develop the deposits under a new Venezuelan government. One of those deposits is worth more than $40 billion U.S. Copper extending a powerful rally after topping $13,000 U.S. dollars a ton for the first time. There are concerns Trump will put a tariff on copper, which has triggered huge volumes to be moved into the U.S. Copper's role in high-growth sectors like renewable energy and AI infrastructure is fueling demand. Shares of Suncor on the rise today. The energy giant says it has achieved its production targets a year earlier than planned. The Calgary-based company says it had record production in the fourth quarter of last year and its best ever annual upstream production, refining, and use. Here is where we are right now on the TSX, up 195 points and set for a new record close, sitting right now at 32,413. Let's go south of the border. The S&P 500 up 43 points today, 0.6%. The Dow Jones almost a 500-point gain, up over 1%. And then the Nasdaq 138-point move up, 0.6%. Canadian energy stocks are still sinking today on concerns about what the Venezuela incursion means for the Canadian oil industry. Let's go to Teal Lind on this, manager at Lind Equity Fund. Teal, thanks for joining us. We heard the Prime Minister saying today that Canada's oil does remain competitive. Do you see Venezuelan product as a threat to Canada's industry?
No, I believe that the fears are overblown. And if we just, the late Charlie Munger had a famous quote that he said where, show me the incentive and I'll show you the outcome. And so along these lines, I think President Trump will be ultimately left disappointed with the oil and gas industry not living up to what he expects of them. I don't think he appreciates just how much the corporate strategy has changed in the oil and gas sector over the last 10 years. I mean, it used to be all about production growth for most of his life. And yet in 2014, when the oil price collapsed, the only way that the oil and gas industry can get sort of new investment from Wall Street was to abide by Wall Street's new demand that the industry now sort of prioritize maximizing cash flow and profits to accelerate shareholder returns in the form of share buybacks and dividends. And heading off to Venezuela runs counter to those objectives, which are basically embedded in the compensation packages of the board of directors and senior executives of these oil and gas companies.
Okay, so basically the business model has changed, and you don't think that Venezuela supports that. But Washington is floating the idea of supporting the oil companies that go into Venezuela to rebuild infrastructure. Do you think that is enough to lure them back?
No, well, I mean, the White House is saying that if they want to, it's basically saying if you want to get refunded or repatriate what was taken from you, then you have to go in and invest. But I've seen the numbers. I mean, ConocoPhillips is the one that lost the most. They had about $10 to $12 billion of assets that were sort of nationalized and taken from them. And then Exxon had $2 billion. And then after that, it runs pretty small. And so when you look at the numbers that it's going to be required to increase production from 1 million to 2 million, you're looking at tens of billions of dollars. So I can't see why these companies are going to rush in there to have to spend tens of billions of dollars in return for $2 billion or $1 billion to repatriate what was taken from them a couple of decades ago. The ConocoPhillips may be in a different situation because they did lose the most.
Okay, let's get to some other markets, some other storylines. We had another record close for the TSX yesterday. We're headed that way again today. What is your forecast for the TSX this year?
Well, the TSX, I mean, last year, it really had a lift from the material sector. And 75% of the material sector is represented by gold stocks. And if you look at the breakouts of the surges of the price of gold over the last number of decades, it's really shot up beyond where it historically has done in the past. And so I think that the run in the material sector is probably largely done. The financial sector was also up about 30%. And so you had a lot of sectors sort of lift largely last year. And I just think that there's probably due for a breather. So I think the TSX, which really outperformed the U.S. market at its strongest level in a couple decades, is probably due for a breather.
Okay. Are there other wider reasons to be cautious this year?
Oh, yeah. There's no shortage of reasons to be cautious. You've got, I mean, market history. If you look at the U.S. market, it's a U.S. midterm election year, and those years have been noticeably underperforming the other years. I mean, since 1950, the U.S. midterm election year, the average return has been 3.8%, compared to about 11% for the other years. You've got valuation risk. The U.S. market, the S&P 500 is trading around 22.5 times this year's expected earnings, which is based upon 13% earnings growth this year. And so you're really sort of priced for perfection, and there isn't much error for error. The margin for error is slim. And so any kind of disappointment could easily compress the market multiple and create a sell-off. You've got AI perhaps being a double-edged sword. I mean, AI has been responsible for a lot of capital investment, GDP growth, and stock market optimism. But if AI truly lives up to its potential of replicating the human mind, then massive job displacement will inevitably start to occur. And if that happens in a consumer-based economy, that's probably going to dampen enthusiasm for the stock market. And then finally, you've got policy risks. I mean, inflation is still running over 2%, sometimes close to 3%. You've got a Federal Reserve that's being pressured by the president to lower interest rates. He's going to be able to choose his own Federal Reserve chairman, which was expected to adhere to his desire to lower interest rates. President Trump even said that he expects the new Fed chair to consult with him on interest rate decision policy. And so lower rates, and so the risk is you can have a run it hot scenario where the Federal Reserve is lowering interest rates while inflation is still high, and you could have backlash from the bond market, which could push up long-term yields, which will certainly put pressure on the stock market. So
okay,
those are just four risks.
That being said, is it a bull year or a year for the bears?
Well, I mean, there are reasons to be bullish as well. I mean, you've got market history again. Whenever you're in the fourth year of a bull market like we are right now, there have been 7 instances since 1950. The average return has been 12.8%. You've got interest rates coming down. I mean, that is a positive, but it's probably more of a short-term positive. You've got fiscal policy. You've got the Big Beautiful Bill Act, where they have front-loaded the tax cuts, front-loaded increasing, which was going to cause an increase in discretionary spending, and they're pushing back into later years the government spending cuts. So that inevitably is going to have an increase in consumer spending and corporate profitability. And then finally, you have deregulation. The Trump administration, in one of its executive orders in January, was called the 10-to-1, which meant that for every new regulation that was imposed, 10 older regulations had to be repealed. And they've also frozen regulations for compliance, which is expected to save billions of dollars in costs for consumers and companies. And so, I mean, there's a number of reasons. Now, if we have to decide which side is most likely to prevail, I think if you look at the trifecta of monetary, fiscal, and regulatory forces that are in play, usually you see that being applied during a recession and to help revive the economy. And so you're having those three forces aligning right now. And so it's really sort of adding fuel to the fire. So at least in the short term, that's going to be supportive of the economy and therefore the stock market. So at least for the current year, 2026, we're in the that tips us into the positive camp.
All right. I do want to get to one or two of your stock picks. The first one you like is Intact Financial. What do you like about Intact?
I think, well, with these top picks, these are ones that I would consider to be long term, not to look back in 12 months, but sort of buy and hold for forever stocks. Intact is simply a more consistent and stabler financial company than, let's say, the Canadian banks. 10% earnings per share growth over the long term, and room for acquisition still within Canada. Property and casualty insurance is what Buffett's invested the most in over his career, and PNC and Intact, I think, would fit the bill for what he would identify as a high quality PNC insurer.
Okay. Quickly, because I'm running out of time, I do want to get to your next pick, which is Uber. Do you see some growth for Uber? If so, where?
Well, Uber, it's more this time I would call it like a Peter Lynch type pick. I mean, if you look around at the companies and the providers that you pay money to, I mean, it's pretty incredible how much people use Uber. There's not much selection and choice, and they're still growing their monthly users by about 15 to 20%. They're expanding around the world. They've got partnerships with 20 different autonomous vehicle makers, so they expect to be a player in the autonomous sort of the self-driving taxi market. And it's trading around 24 times your expected earnings. So you're getting you're paying a near market multiple for a company that's growing much faster than the market.
All right, Teal, I got to leave it there. Thanks for joining us on The Close. We'll talk to you soon.
Thanks for having me.
Coming up, a deeper look at the fallout from the capture of the Venezuelan leader, Nicolas Maduro. Back in a moment. American oil stocks surged yesterday, but Canadian energy stocks were down following the Venezuelan incursion, which is fueling concerns about global energy markets. CTV's Rachel Aiello has more on that.
As the market absorbed the potential implications of U.S. President Donald Trump tapping Venezuelan reserves.
I think everybody needs to take a deep breath. There are so many steps between here and them starting to grow production enough to really start to compete with Canadian oil.
After ex-leader Nicolas Maduro's weekend capture, Trump sent shockwaves around the globe, musing about more military invasions.
It's by no means all about the oil. It's about someone defying an American president. That's a pretty powerful example for those who are left.
Canada is no stranger to Trump's annexation threats, but the president's former national security advisor says he doesn't think this country is at risk.
I think any kind of move against Greenland or even more far-fetched against Canada would be the end of the NATO alliance. It would do incalculable damage, not just to the United States, but to the entire Western world.
Prime Minister Mark Carney's response so far has been careful, and critics say Trump's actions are exactly why Canada increasing its economic, military, and diplomatic independence is essential.
Internally, I think this boosts the obligation for Canada to get very serious, for Parliament to get very serious about diversifying our trade exports beyond the irrational administration of the United States.
Carney spoke to Venezuelan opposition leader Maria Corina Machado on Sunday, pledging Canada's support for a peaceful, negotiated, and Venezuelan-led transition process. And Venezuelans in Canada expressed cautious optimism today.
We're pretty happy of what transpired.
The biggest happiness to the biggest worries.
I think it's time for Venezuelans to be happy again.
Global Affairs is urging Canadians to avoid all travel to Venezuela, citing the unstable political situation and escalating security risks.
That was Rachel Aiello. So after being seized by the U.S. military, then brought to New York to stand trial, Venezuela's ousted leader claims he's a prisoner of war. CTV's Roy Malbert reports.
Dramatic images show Nicolas Maduro, who days ago was Venezuela's president, handcuffed and escorted by police officers. He and his wife Celia Flores charged in the U.S. with narco-terrorism conspiracy, cocaine importation, and weapons offenses. Maduro defiantly told the judge in Spanish, "I was captured at my home in Caracas, Venezuela. I am innocent. I am not guilty. I am still the president of my country." Maduro's lawyer attacked the U.S. military raid, the abduction and arrest, as many question Was this even legal? Demonstrators lining the courthouse. Some celebrated President Trump for bringing down a brutal dictator. Others pleaded no more war. At the UN Security Council, several nations condemned the Trump administration's military raid, calling it a breach of international law.
I remain deeply concerned that rules of international law have not been respected. The Charter enshrines the prohibition of the threat or use of force against the territorial integrity or political independence of any state.
Still, President Trump's not backing down.
We're going to run it, fix it. We'll have elections at the right time.
And boldly issuing new threats against Mexico, Greenland, and Colombia.
Colombia is very sick, too, run by a sick man who likes making cocaine and selling it to the United States, and he's not going to be doing it very long.
Joy Melvin, CTV News, Washington.
Coming up, we will zero in on Canada's energy sector in the wake of that capture of the Venezuelan leader. We're back in a moment. The American leader wants American companies to revitalize the oil industry in Venezuela. And if that happens, what does it mean for Canada's energy sector? We sat down with Patrick O'Rourke, Managing Director, ATB Capital Markets, to talk about that.
It's very likely that there's going to be an impact, but we have to kind of understand what that impact will be. So first of all, and I think this has probably been highlighted many times over the last few days, the vast majority of our heavy oil is processed in the Midwest. That's exported to the U.S. And most of that cannot be replaced by Venezuelan oil. The oil production that is at risk today is the oil that we ship to the Gulf Coast. And those barrels can be replaced. The Venezuelan crude is very complementary. Today, they export about, call it somewhere in the neighborhood of 600,000 barrels a day to China. That's very similar to the volume we send to the Gulf Coast. If those are redirected in there, that could put a little bit of pressure on the prices that producers receive in that particular market. Now, those barrels, if they come out of the market, the net demand globally for heavy oil doesn't change. And so that gives us an opportunity to maybe move some more barrels and get some better pricing on mechanisms like TMX. But I think it also opens up a broader question. We recently had the MOU that was signed between the Alberta government and the federal government, and it probably puts a little bit more impetus on actually executing on something like that in the medium and longer term. And then if you look at Venezuela itself, if you think about the longer term production growth capabilities, I think there's a lot of question marks that still remain around reserve quality, infrastructure quality, capital that's going to need to be invested, the regulatory regime that's going to be in place. Significant capital needs to go in there. I think that, large super majors are going to want, a pretty clear line of sight on the political regime change and what that means before they're willing to make those commitments. So I don't think it's going to be an immediate production growth to compete with our barrels, but there are some risks, certainly, and we're watching those very, very closely.
You have an interesting point here that we saw lots of takeover speculation in Canada, oil takeovers. We saw some deals, the biggest was Cenovus buying Meg Energy. You think a lot of the prizes, the juiciest companies may already have been taken out?
Well, if you look at the different asset classes in Canada, the oil sands have gone through significant consolidation. We've seen that over the last several years. You spoke to Cenovus and Meg there. There's very few sort of pure play, scalable brownfield or greenfield oil sands assets that are probably ripe for consolidation. One we've talked a lot about is a company like Athabasca, but I think organically that business stands on its own. And then in the Montney, particularly in the condensate-rich fairway, we've seen a significant amount of consolidation over the last 3 years. And so our M&A thesis in 2026 really revolves around finding assets that are very deep in high-quality inventory, not necessarily very short-term free cash flow accretion, but solidifying the inventory perspective. And that's, to be frank, that's been a bit of a headwind in the U.S. for some of those producers as they've seen the quality of the tiering of the future locations sort of degrade as they've harvested their best locations first. And that's where we see the opportunity in Canada to remain as, high depth inventory, high quality assets are most in favor, in our view.
Just to zero in on a couple of stocks, Suncor is an oil sands giant that you're less keen on. I mean, the stock's had an amazing run. Why is it? Why is that? You have a hold, I believe, on Suncor at your shop.
Yeah, we've got a sector perform on the stock. I think, it's probably outperformed our expectations. So good on them. They've done an excellent job. They had a great operations update yesterday evening, record production, record throughput in the downstream business. So obviously from an operational perspective, they're firing on all cylinders. They've met their, sort of multi-year strategic plan a year ahead of the time frame here. The next key will be they're going to do an investor day on March 31st and sort of laying out the path forward here in terms of replacing what's, sort of a well-known issue in terms of base mine reserve life. I think that, it's fairly clear that they have those assets that they can do that with. But, the capital outlay and the strategic way that they do that is a question mark for investors. So, I would say if you look at it and we put our outlook out before the news on Venezuela, I would say Suncor is actually somewhat well positioned here considering the volumes of upgraded crude that they produce and then the insulation they have through their downstream business.
As a co-owner of the Trans Mountain Pipeline, because I'm a taxpayer, I'm actually thinking of going down to one of the valve houses and keeping an eye on them and giving them some tips. I'm sure they'd appreciate it. But in any case, Trans Mountain Pipeline tolls have been something of a sore point. There's been an effort by the oil patch to bring them down. And you say that if that happens, Cenovus could be a big winner here, and Canadian Natural too.
Yeah, Cenovus and Canadian Natural are both two of the largest shippers on that particular pipe. There is a negotiated toll process that's going on now. We should have some sort of view of how that's going to look by early February. So we're watching that very closely. But any sort of change to the tolling structure there, if tolls do come down, I would say that those two producers are the biggest beneficiaries. And, then there's a knock-on effect to WCS at Hardisty, which is the in-basin pricing. And Cenovus would be well positioned to capture any improvement there.
Patrick O'Rourke, Managing Director, ATB Capital Markets. A quick look out the markets ahead of the end of the trading day, with the TSX up again today and poised for another record close. So it's moved up 177 points to 32,395, so just over 0.5%. S&P 500 up as well, 43 points. The NASDAQ, 152-point move up so far on the day. We're back with the closing numbers in just a moment. Stay tuned for that. Here are the closing bells for the end of the trading day. At the NASDAQ, Well Hub ringing the closing bell. In New York, the Belly to celebrate the launch of 3 new ETFs. And in Toronto, Vinland Lithium celebrating the company's new listing on TSX Venture Exchange. You're watching The Close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. So another record close for the TSX. 32,407 is the new close. 188-point move up today, about 0.6%. The S&P 500 gaining 42 points today, up 0.6%. And the NASDAQ, 151-point move up, again, 0.6, almost 0.7%. Let's get to the movers in Toronto. First, Majestic Silver moving up today, gaining over 10%. Or $2.36 a share, taking it to $25.83. That's up $208 in the last year. Stephanie Hughes will have more on this in just a moment. Let's get to Endeavour Silver. It also moved today, gaining over 8% or $1.13, taking the share price to $14.61. Lithium Americas up today as well. It's a 5% gain of 36 cents to $7.55. And then Allied Gold, another precious metal, moving up today, gaining over 6%, taking the share price to $34.65. It's a 221% gain over the last year. Let's move to the flip side. Enerflex down today by just over 4%, an 88-cent drop, taking shares to 20.56. Bombardier also down today, 4% drop, losing $10.66 per share, taking it to 238.31. And then Baytex Energy also losing today, over 3%, a drop of 15 cents a share. Let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now to talk some more about what went on. Stephanie, investors still moving into precious metals. Tell me about the gain for First Majestic.
For sure, Morella. Yeah, so metals miners are seeing their gains being extended as we're still grappling with this Venezuela story. And that has really put First Majestic on the move. As you mentioned in your stock movers hit, it's up by over 10%. Apparently it moved since I went from my desk to the studio here. It moved even further. So that's what brought the stock price to levels that we haven't seen since February 2021, maybe even earlier than that. So at least nearly 5 years since we've seen the stock price rise to that level, and clearly regaining a few years worth of losses. And it's the same story that was driving gold and silver prices yesterday. It's the geopolitical tensions really being ratcheted up after U.S. forces moved in and captured Venezuela President Nicolas Maduro. And that prompted traders just to act skittishly and with uncertainty to move towards these safe haven assets that gold and silver typically provide. And that's been not only even the story this year, but for different reasons, been the story for a good chunk of last year as well. So that in turn, obviously, gives a rise to the companies that pull these metals out of the ground. So when I was looking at First Majestic, it was already up by 11% so far this year, just in a few trading sessions. Obviously, with today's gain a bit more higher than that, but that has already made it its best start to the trading year since in just about 5 years, or at least since 2020. That's how far back I went, but it's probably its best year, even going further than that so far. So First Majestic is in good company with a few other mining TSX-listed miners, including Endeavour Silver, which you and I talked about yesterday, Aya Gold and Silver, New Gold, and a few others. So it's a story that's still sticking around with us and still pushing those gains higher in the metals mining space, Marilla.
All right, definitely people going to the precious metals when they don't know what Donald Trump's going to do next. Bloomberg's Stephanie Hughes, thanks for the update. Appreciate that. Let's go south of the border and check out the movers there. Bloomberg senior equities reporter Bailey Lipschultz is joining us. Bailey, Jensen Huang's comments always make headlines. The NVIDIA CEO spoke about AI memory storage. What happened after that?
Yeah, making headlines and moving stocks. The best performer today on the S&P 500 was SanDisk, a memory maker, and we saw a number of other memory chip makers rallying sharply. And we're not talking about a few percentage points. SanDisk was up more than 20% for the bulk of the day, and this came after, as you mentioned, Jensen Huang talking about the need for memory chips and how they will be so implemented in terms of AI and the enthusiasm around that. As you can see, Western Digital also up 17%, Seagate up more than 10%. A number of these companies either closing at all-time highs or the highest levels in a number of months. Analysts really pounding the table saying this is a positive data point, again, when we see the NVIDIA CEO making the rounds, talking about everything, whether he's moving to the downside, the power and cooling companies, which we saw as a big sell-off today, or moving to the upside, some of those storage chip makers.
Okay, let's talk about Microchip Technology reported earnings. What did that company have to share?
Yeah, this is a company that reported preliminary earnings, so not in the memory space, but in the analog chip space, so providing a lift for a number of companies and having its best day since, I believe, late October, rallying on news that they had preliminary results for the December quarter that were above what Wall Street was looking forward to. And a number of analysts even said that they expect the numbers to be even better than expected. So a big boost for a company that kind of had been stuck in a rut. As you can see, up more than 11% on the day, but this is a stock that is at the highest level since July. So as much as we've seen a number of chip makers or pretty much anyone in the space and industry rallying, this is a company in been an industry that has been challenged for a bit. But a big move today, again, lifting some of those peers, looking at the likes of onsemi, NXP Semiconductors, as well as Texas Instruments. So a big, solid step forward. Again, we're in earnings season, or at least preliminary earnings season, so it'll be certainly something we keep an eye on.
Okay, then credit reporting companies taking a hit in the U.S. today, and that's connected to upping prices. But give us the backstory here.
Yeah, so these are groups that provide credit scores. So if you go to buy a house, you need all three essentially to do a check and kind of report to banks what the status of a buyer would be. And they raised their prices pretty sharply, and that drew the ire of Bill Pulte, who helps really oversee the FHFA, and really kind of he was hitting back, taking on social media, saying that kind of the credit bureaus raising their prices is negative for consumers, pushing back on that narrative, being very critical. So as you can see, Equifax down almost 4%, a bigger drop off for TransUnion, and we saw a number of other companies taking it on the chin. The big concern from analysts and investors today was, what does this mean for kind of the tri-merge? There are three companies, whether or not they are viewed as having a monopoly is what Pulte is kind of pushing, and the fact that they can raise prices as sharply as they did kind of drew their pushback, but also we do want to include that the companies had said that essentially their costs are going up. So in kind, they need to raise their prices, kind of pushing back on Pulte's stance, but it'll certainly be something that ebbs and flows, again, kind of with how vocal the administration is and how vocal Pulte has been, whether it's with credit scores or mortgage operators and other companies in the space.
All right, Bloomberg Bailey Lipschultz, thank you for that update. Coming up, a bear case for artificial intelligence when we come back. Looking at the year ahead, our next guest published a 2026 outlook, which he named Return of NASDAQ. He says the U.S. is dangerously dependent on the AI boom. Peter Berezin joins us now, Director of Research at BCA Research. Peter, thanks for joining us today.
Good to be on.
So we know AI was, of course, the big driver last year. You think that story is going to sour. Why?
I'm not so much bearish on AI as a technology. I'm bearish on the investment thesis around AI. If you take analyst expectations seriously, the hyperscalers, Microsoft, Amazon, Google, Meta, Oracle, are on track to hold something in the order of $2 trillion in AI assets by 2030. Now, the depreciation rate on those assets is around 20%. So we're talking about $400 billion in annual depreciation expense that they'll face. That's more than their combined profits this year. I just don't think that sort of investment can be readily monetized, which means that those capital spending expectations will come down, and that's going to hurt companies such as NVIDIA.
Okay, so when you say readily monetized, that has been the big sticking point for some investors as well. Where's the return on capital? And you don't see that happening anytime soon?
Yeah, my guess is that it won't take as much money to create the AI economy as a lot of investors assume. And I think a good example is the internet. If you look at the amount of data transmitted over the internet, it has grown exponentially over the last 25 years, averaging an annual growth rate of 42%. And yet, if you look at the amount of money that's necessary to maintain the internet, that has actually declined as a share of GDP since 2000. So what's going to happen with AI is that we're going to figure out how to do AI without spending trillions of dollars. That's coming. The newest models are much more efficient. We're going to get better chips. We're just not going to have to spend the trillions of dollars that investors are currently assuming NVIDIA will receive and other companies will receive in the AI space.
And so you see a bear market coming around and happening in two stages, or at least a possibility is there. What would the first stage of that look like?
Well, I think the 2000 period is a good template for what could transpire. Now, what happened back then was that internet stocks peaked around April of 2000, and they fell significantly. The S&P 500 IT sector fell by 55% between April 2000 and May 2001. And yet, if you look at what happened to the other parts of the S&P 500, those stocks actually went up by around 10%. So we had this massive rotation from tech to non-tech, from growth to value during the first year of the bear market. It was only when the decline in stock prices associated with tech companies and the ensuing tech bust dragged down the whole economy, and you had a recession, that everything began to fall in tandem. And so I expect the same thing this time around. I expect non-tech to do well over the next 6 months, but then as the AI bust ensues, the economy will fall into recession, and then everything will begin to weaken.
Okay. Would you say that the end of last year, in the fall, we already started moving that way, with tech sort of stopping its momentum and people moving to sort of more tried and true companies that they like the bottom lines better?
I feel we are moving in that direction. Increasingly, companies that have announced a lot of AI capex are not being rewarded by shareholders rather than being punished. And Oracle is a good example. Oracle's cash flows have been deteriorating very, very dramatically. It's having to take on new debt to finance this spending that is promised OpenAI, and its CDS spread, its credit default spread, has widened, and its share price has fallen. And that sends a message to other tech companies that they have to be careful. If they spend too much, they're going to get punished. And of course, if companies feel that, they're not going to spend as much as they otherwise would.
Factor in the tariff decision we're waiting for from the U.S. Supreme Court and how you see that playing into the markets.
Well, the economy, I think, is weaker than most people realize. Housing is weak. The underlying foundation for consumer spending is weak because the labor market is struggling. If the tariffs are struck down, that would provide, I think, a very, very helpful tailwind, at least a near-term tailwind for the economy. The caveat, however, is that we don't know how bond markets will react. If you take away this very lucrative source of revenue at a time when the government is running a budget deficit of 7% of GDP, that could spook the bond market. And if bond yields go up in response to such a decision, that could offset any of the benefits from lower tariffs.
What about the One Big Beautiful Bill that's meant to put more money in the pockets of Americans? How could that offset?
So certainly on the face of it, the One Big Beautiful Bill will be a tailwind for growth. Not a huge tailwind. We're talking about maybe 0.5% of GDP, but nevertheless a tailwind that will help to keep growth in check. Again, the question mark is around how the bond market reacts. The Fed has been cutting rates now since September 2024. It's cut rates by 125 basis points. When the Fed began cutting rates, the 10-year bond yield was 3.65%. Today, it's over 4%. So longer-term bond yields, which matter more for the economy because they dictate what happens in the housing market, they've actually gone up as the Fed has been cutting rates. And one of the reasons for that is because we have this huge fiscal deficit in the U.S. And the problem with the One Big Beautiful Bill is that it adds to the deficit. It doesn't subtract from the deficit. And so, again, we have to worry about the bond vigilantes potentially undermining any fiscal stimulus or any decision to strike down those tariffs.
All right, Peter, got to leave it there, sir, but appreciate your time. Peter's Chief Global Investment Strategist, Director of Research, BCA Research. Coming up next, how is Trump's incursion into Venezuela impacting Latin America? We'll hear from someone on the ground there when we come back. When it comes to Trump's incursion into Venezuela, we've spoken a lot about the impact on the oil market and the impact on Canada, but how do people feel about it in Latin America? Let's go to Jimena Zuniga. She's a geoeconomics analyst for Latin America with Bloomberg and joins us now in Buenos Aires. Thanks for joining us today. Jimena,
Thank you so much, Morala.
How is this incursion being viewed where you are?
Yes, it is viewed with cautious optimism in the sense that for years Venezuela has been under an incompetent and repressive dictatorship that led to a collapse in the economy and the diaspora of over 8 million Venezuelans. So for a while it seemed implausible that the regime could change. Now with Maduro out of the picture, there's hope that this can be achieved. Of course, it's a difficult path, and some of Trump's remarks have raised concerns that democracy is not the objective of the U.S., but we think that there are reasons to believe that it can work, even though it has clear risks.
How do people feel about the U.S. running the country and, more precisely, trying to run the oil industry in Venezuela?
I think, of course, that casts a little bit of disappointment among Venezuelans who are hoping that with Maduro out, there will be a soon establishment of democratic government. That said, I think it's wise to try to look at the U.S. Strategy by giving it the benefit of the doubt, in the sense that a key priority of the U.S. seems to have been, while there's a lot of talk about the oil, a key priority seems to have been to guarantee stability, in the sense that there was the big risk that a rapid takeover by the democratic opposition in Venezuela, who are by all accounts considered the rightful winners of the 2024 elections in Venezuela, and who want to take over. The risk was that if they took over without having solid civilian control over the military and the police, those who have the guns, there could be a descent into infighting and chaos with dramatic humanitarian impacts. Okay. And so it's possible the U.S. was likely trying to avoid this.
That being said, as you alluded to, it does sound like it's the beginning of now a political struggle, because Trump seems to support the government that was already in place, but under the vice president. Others think that it should have been the opposition leader who would be elevated. So should we expect to see more of a power struggle follow now?
Totally, and we don't know what the counterfactor would have been if the opposition had taken over immediately. But the U.S. has a case to say if the opposition had taken over immediately, this could have been a very chaotic scenario. So what the U.S. is trying to do is for Delcy Rodriguez to deliver on some U.S. requests that, if successful, can pave the way for a more solid and lasting democratic transition, namely dismantling drug trafficking networks that presumably involve disarming widespread militias that sow terror in the country, and also removing from the territory foreign elements associated with Hezbollah, FARC, and ELN from Colombia that would also undermine a democratic transition. So if there is some progress in this, there is a chance that the democratic opposition could take over on a more solid footing. Of course, there's risks that if this lingers on for too long, there could be violence anyway, as you suggest, because of a power struggle, and also a more clouded political outlook, as well as not as much economic upside.
Jimena Zuniga is with Bloomberg Economics, joining us today from Argentina. Thank you very much for your time. I appreciate that. All right, Las Vegas buzzing this week as the Consumer Electronics Show takes over that city. It's where tech giants and bold innovators unveiled their latest gadgets. For a closer look at what is turning heads on the show floor, let's go to Bloomberg Carolyn Hyde. She joins us now. Carolyn, I've always wanted to be there. What is it like on the floor?
Noisy. At the moment, I think they're doing a karaoke demonstration, so we've got a plenty of sound when it comes to innovations in technology. But there are some crazier side of the equation. I've just been looking at AI-powered toys, which are sort of little, small animals that a child can interact with. But there's more use of generative AI, even when it comes to lollipops that have been given out that can play music as you eat them. So I think that there's a whole raft of things that on the sillier side of things, but then there's the real use cases of AI. Look, we don't just think about how the way in which we're going to deploy health for our AI needs. Look, we're looking at massage chairs. You're looking at how entire big hardware are going to be put around you and help your body and recover in many ways. But it's a lot about the AI-enabled gadgets that you're going to be putting on when it comes to jewelry, when it comes to rings. We're also seeing AI infused in robotics. I think that's where the big tech players start to interact with the smaller startups, because what's so interesting is you've seen Jensen Huang of NVIDIA, seen Lisa Su of AMD. I've had Qualcomm CEOs just sitting next to me talking about the way in which they're empowering new robots to come to work within the home, to work within industrials and in manufacturing in particular. For that, they need some very heavy-duty compute to be able to train the large language models that these computers and robots are based upon.
Yep. I've already seen the video of the robot that's going to do my laundry one day, which is great, although it was working pretty slowly. What else are you seeing? I know there have been some self-driving car announcements as well.
Thick and fast. Everyone wants in on the auto space. And actually, you saw a post come out late last night from Elon Musk saying he's not losing any sleep over the latest announcement coming from NVIDIA that they are producing a overall model to be helping with these autonomous drives. In fact, you're going to see Mercedes-Benz being the first car that's going to be powered by NVIDIA's new technology. And that's coming out as soon as the first quarter of this year. So that's going to be on the road. It's not going to be any sort of level 4 autonomous, but it's going to be moving its way towards that. But also baked into the NVIDIA partnership and ecosystem are companies such as Lucid, the CEO sitting down with us a little bit earlier. He's an interim chief executive of the EV maker in the United States. And that particular company is teaming up with NIO. It's also teaming up with Uber to put robo-taxis on the road. They think that'll be happening in the next few years. At least by 2029, the regulation will be there. But he's also working with NVIDIA to infuse autonomous driving in a level 2 and a level 3 scenario to you and me, the consumer. So it's not just B2B, it's B2C. But it really does feel as though autonomous driving is coming in everyone's announcements. We heard it from Qualcomm as well, how much they're endeavoring to bring it to your cockpit when you're in the car and your interaction with infotainment, but also how you're using it on the road and how it's going to be driving you safely on the highways in several years to come. He thinks, and I add, that Elon Musk is closest to full self-driving.
I can't even get used to cruise control, but that is me. Bloomberg's Carolyn Hyde, thank you very much. Appreciate your time. Coming up, 2026 has started with instability after, of course, U.S. capture of the leader of Venezuela. We'll discuss the key geopolitical and other risks to investors need to watch out for in 2026. Back in a moment. Eurasia has unveiled its top risks report for 2026, citing the U.S. as the principal source of global risk. Now let's get more from Gerald Butts, Vice Chairman, Senior Advisor, Eurasia Group. Thanks for joining us today.
Oh, it's great to be here, Marilla. Happy New Year.
Same to you. I was looking at this report. It's an uncomfortable read, to say the least. Yeah. Would you say the U.S. has already been sort of the biggest source of global upheaval last year?
Oh, for sure. And for the past several years running, I think. For Canadian viewers in particular, we're accustomed to having the U.S. be the most important shock absorber of political risk in the world. And for the last few years and for the foreseeable future, it'll be its most important generator.
So what do you see changing this year?
Most importantly, it's an acceleration of institutional decline in the United States. Last year, when President Trump was about to be inaugurated, when our report came out, we highlighted what we called at that point the rule of dawn. And that meant that we expected President Trump in 2025 to feel, at least compared to the way he governed in the first term, relatively unencumbered by any of the guardrails that were there when he was president the first time. And I think what we've seen is exactly that. And as he approaches a very difficult midterm season, we expect that process to accelerate.
Okay. Does this process, as we move forward, include moving on other countries like we've seen him move on Venezuela?
Well, I think that's the challenge with this risk, Marilla. It's really hard to tell day to day. Had you asked us last January, we would have said the chances of him sponsoring a coup in Venezuela would be pretty low. Had you asked us in October, we would have said it was pretty high. So part of the challenge of moving from a world where you've got an international trading system and a geopolitical arrangement that's based on rules to one that's based on deals is you have a very difficult time figuring out what comes next. And I think we're telling investors and our clients around the world to prepare for the unexpected when it comes to the United States in 2026.
What would you say has been the effect on Europe so far, and how will that manifest this year?
Well, as you see in Europe, I mean, Europe is kind of the sick man these days, or the sick woman. They've got a bunch of weak governments in really consequential countries. You've got a prime minister in Great Britain and Keir Starmer who's under siege. You've got President Macron who's headed toward the end of his mandate. Germany's in rough shape. It's a very difficult, unstable political environment. And when you couple that with the pretty extraordinary national security strategy that the United States published a couple of months ago that basically says they're going to ally themselves with political parties that share their view of the world rather than governments that share their values. That's quite a difficult situation for Europe to be in. And of course, here in Canada, we're all thinking about Greenland for obvious reasons, and the Europeans are quite seized with that. The Danish Prime Minister said yesterday, if this is a serious thing, it's the end of NATO. And there's probably nothing more serious than that for Canada.
Yeah. Another serious thing for Canada is what happens with the trade deal for North America. And you're saying it will be a zombie USMCA. What do you mean by that?
Well, we mean that it'll be an agreement on paper, and it will probably be the one we have now, but it will be very difficult to enforce. As your viewers may recall, in the last round of negotiations that turned NAFTA into the USMCA, the main sticking point at the end was whether we were going to have a independent third-party dispute resolution mechanism. And it's almost comical to think that Donald Trump 2.0 would sign off on such a thing. So that means that we're going to face a year of pretty bellicose threats from the United States. The government here will have to steel its nerve to stand up to those. And the upshot of it all is, unfortunately, we're going to have a semi-permanent lack of certainty for investors in North America.
How do you see the China-U.S. relationship changing in 2026?
Well, here's one where last year we called it as a red herring that there was going to be a great power conflict between China and the United States, which a lot of commentators thought was going to happen heading into Trump 2.0. We thought that Trump would realize pretty quickly in his mandate that the Chinese have real cards to play that could cause him political harm and cause the United States economic harm. That's precisely what happened in April. And I think since then, you've seen Trump settle into almost a rapprochement with China. We don't expect any major conflict between China and the United States. It's kind of strange that that's one of the few places where we don't see significant conflict and risk for investors. But longer term, that's still a relationship that's going to be restructured, but we just don't see anything material happening in 2026.
Interesting. Okay, let's talk about AI for a moment as well, because all the talk has been AI for the last couple of years, so much growth last year. What is your take on what happened for 2026 with AI?
The main thing is that there's going to be a backlash against the companies, and our risk is called AI eats its users. Basically, the pitch that AI has given the public so far has been, first, we're going to raise your energy bills, and then we're going to take your jobs. And in a year where a lot of Congress people in districts where giant data centers are being built are going to face re-election, that's going to bite politically. So we're going to see a backlash this year is what we expect.
Gerald Butt, good to see you. Thank you very much for sharing the details of that report, and we'll talk again soon.
Thanks very much, Marilla. Happy New Year.
Same to you. All right, coming up next, Siemens and NVIDIA today announced an expansion of their strategic partnership to bring AI into the real world. We'll tell you what that looks like when we come back. Siemens has been at the forefront of several industrial revolutions, but NVIDIA is at the forefront of the latest, the AI revolution. Our partners at Bloomberg sat down with Roland Busch, President and CEO of Siemens, and Jensen Huang, CEO of NVIDIA, to discuss their plans to build the industrial AI operating system.
This technology is already in place and it's working. I mean, we see that in many examples, and I brought some on stage today, where you have customers starting with a digital twin of a product they want to manufacture, a digital twin of the manufacturing side, and bring that all together. And not before that, you have it optimized and build it in the real world. And AI is already working on the shop floor. They call it machine learning. But the point is, with the new models, you can bring that to the next level. That means you go away from giving an advice to somebody with technology, but really act on your behalf. This is when things go more autonomous or adaptive. And you see that already starting. The big thing is, how can we scale it? Because it requires a lot of skills from our customers, a lot of technology, and it's still not that easy to implement. We are working on it to make it easy to deploy and easy to use. But you see picking up momentum with each step we do. And we saw some great examples. Is it shipbuilding? Is it food and beverage? But even startups using our technology like Commonwealth Fusion Systems.
You know, Jensen, we've discussed the 5-layer cake often. You know, with NVIDIA, it started with the GPUs, but it's now software. The element of simulation. On stage, you talked about integrating the software side in particular into EDA. Again, it's a similar question for you, more of a timeline. What is it that you think you'll do first in how you guys work closer together?
Well, the first thing, let me just say very quickly, we're announcing a big partnership between us. We've known each other for a long time, but the partnership we're announcing is really a big deal. One, we're accelerating their EDA software. We're accelerating their simulation software. We're integrating AI technology, physical AI and agentic AI, into their team center and their factory automation operating system. And so we're working together across this entire spectrum. When we accelerate the software, then we'll get to use it to design our chips and systems. When we accelerate their simulation software, we'll use it in our AI factories to simulate the thermal properties of our AI factories. When we integrate our automation and agentic systems into their AI industrial operating system, we can then use it in our factory floors with our partners, for example, Foxconn. And so we're working across this entire spectrum together, and we're going to put the technology to use basically as soon as we can.
What's the net effect for you, Jensen? Is it improves margins, efficient capital allocation? I know that might sound a bit dry, but actually right now that's the answer everyone's searching for. How has this investment in AI and use of the technology actually changed things in the real world for me?
Well, we announced yesterday Vera Rubin. It takes 6 different chips to integrate into this incredible system called Vera Rubin. And when you're done, each one of these Vera Rubin GPUs is 240,000 watts. And it is 10 times more energy efficient than the last generation. It is 10 times more cost efficient than the last generation. But it's still, the technology is insanely complicated. 15,000 engineering years came together to build this system. And so when we accelerate EDA tools, when we accelerate simulation tools, and when we can eventually, and I'm hoping very soon, design entire Vera Rubin systems inside a Siemens digital twin, the ability for us to create much, much more complex systems will scale. We'll do it much more efficiently. And so this is really about being able to do the impossible and being able to do it the impossible right the first time.
And please let me add, once we then realize that AI creates real-world impact, this is where it really deploys the full power and also the economic power. It's not only in the data centers or in AI factories, which we see, but also on the edge, because once you start inferencing with low latency, you bring this technology to the edge. There's a huge potential for our customers to deploy this technology, and this includes, of course, hardware, where we come from the chips. It goes into the controllers. Some of our controllers run on GPUs.
Yes.
And then it goes all the way to the
used to call it industrial PC.
Exactly.
Yeah.
And we
now these industrial PCs are AI industrial PCs.
We supercharge it, and they can now run algorithms trained in the cloud. They can run it on the shop floor and do all that trick, what we talked about it in real-time optimization and running in a plant. And that makes a huge difference.
Again,
it drives economic growth.
The question that's being searched for is how is this going to manifest in the real world? You know, the emphasis at this year's CES, I think, is physical AI. Is not the manifestation of the final stage of physical AI just one giant robot that you guys call a factory in the manufacturing context? Is that where you're seeing demand from actual customers? You know, they need a factory that is automated 100% and genuinely autonomous in some degree.
So number one is if you want to build a factory and very often you're missing out on labor. And we talk about skilled labor. It's hard to find, number one. Number two is once you build it autonomous and automated, then you have a much, much higher yield, what you can generate. You use less energy, by the way, at the same time, you really optimize it in a way. So therefore, there's a lot of benefits. And if you want to, talk about the United States, ramp up manufacturing in the United States, you need to go as digital and as automated and AI supercharged as possible.
A factory is robotic, and it is orchestrating robots that are building systems that are also robotic. Like, for example, self-driving cars is a robotic system. And the reason why it's so hard to deploy robots today is because it's hard to program these robotic systems. The software expertise necessary, the customization necessary is really intense. It's just too much. And so the fact that we could now apply artificial intelligence, physical AI technology to these robotic systems, make them easier to teach. You show it a few demonstrations and the AI learned it by itself.
Would you go as far as to say, Jensen, that you've solved for that software limitation?
That software limitation is the ChatGPT moment of it is now here. I think over the course of the next couple, 2-3 years, we're going to make some really big breakthroughs.
Let's please talk about energy, electricity, power supply, call it what you will. In turn, for each of you, how worried are you about it as a bottleneck? And what is your experience day-to-day in running both companies in that respect?
Well, energy should always be a bottleneck for any industry. And this is a new industry that's growing incredibly fast. As you know, AI is both a technology that's going to revolutionize many applications, and we're talking about some of them here. But the AI industry itself, the manufacturing of the artificial intelligence takes energy. It takes energy, it takes AI factories. It's exactly the reason why from Hopper to Blackwell, we increased energy efficiency by 10x. From Blackwell to Rubin, we increased energy efficiency again by 10x. And that translates directly to our customers' revenues, because in the case of an AI factory, whatever factory size you have, you're limited by the power. And that power, within that power constraint, you want to have the most tokens or most AI per watt that you can possibly generate. And so every time we improve energy efficiency, we're effectively improving both the AI capabilities for our customers and their revenues, because they're always constrained by power.
That was our Bloomberg partners speaking with Roland Busch, President, CEO Siemens, and Jensen Huang, CEO of NVIDIA. Coming up, hot picks in luxury stocks, including a Swiss company with assets in prestigious jewelry brands like Cartier and Van Cleef. Back in a moment. Time now for our hot picks in luxury stocks. 3 companies benefiting from the wealth effect and higher-end consumer spending trends. We were joined by Marcus Hansen, portfolio manager at Vontobel Asset Management, and kick things off with why he likes Financière Richemont.
We're a global asset manager, so we're always looking for fantastic franchises and brand companies, which can complement, good performance in U.S. assets as well. Keep in mind, we're looking also at diversification. Consumer discretionary is an area we find some great franchises. And so coming to Richemont specifically, this is a Swiss-based company, which is a holding company for 2 major assets, one being Cartier, the other one is Van Cleef & Arpels. So 2 of the iconic top brands in jewelry. It's a 120 billion market cap company with about 26 billion of revenues. 80+% of the earnings come from the jewelry business, which is benefiting not only from a long heritage, so there's a proven track record here of over 100 years. We look for good proven track records, but more importantly, pricing power and strong demand as we see jewelry moving more and more towards branded. Good delivery, good execution, we think is a great one to have. And this is a company which is part of the whole luxury high end, very much is a combination of controlling demand, keeping margin, and growing returns.
The chief financial officer at the end of last year apparently warned, though, that higher prices for precious metals are putting pressure on profit margins. That doesn't turn you off?
Not at all. If anything, actually, we think the move in the precious metals market, because there's a combination, they have the ability to hedge going forward and they lock in some of their supply, is actually maybe driving some of the attraction in jewelry that we are seeing versus other consumer discretionary high-end spending. It's interesting also to note that despite these companies, I mean, Cartier itself has been around for 150 years, Van Cleef just over 100 years. They do constantly innovate. And in fact, their new Love bracelet, Cartier is renowned for a bunch of different things, but their Love bracelet is very famous. They have a new version which continues actually to outsell. And there's been issues actually getting that. So that allows them to have pricing power, which more than offsets what we think would be some of the margin pressure.
Your next idea has that evocative ticker symbol in America, RACE, Ferrari.
Yeah, I mean, you couldn't pick a better symbol, right? Ferrari's been around for, 80 plus years. Effectively, it's a luxury goods company that happens to make cars, so things on wheels. But really, if you look at the remit of its P&L, its returns, its margin profile, it's very akin to some of the top iconic luxury brands. This is a 66 billion market cap company, revenues of about 8 billion. And the story here really is a controlled volume management of this business over time. They could sell more cars tomorrow if they wanted to. They don't, primarily to retain the exclusivity, but also they're aware of the fact that what they're creating here is a very valuable asset going forward. Obviously, a bit of a lackluster 2025, but if you look at the track record here of 3, 5, 10, 15 years, the performance is phenomenal. And we think this will be another one which also benefits from what we're continuing to see is good spending on the high end, but also demand for quality, unique assets going forward.
And then your final name also involves fast cars, Formula One Group. I guess we're not going to be buying these cars, but they are part of the whole luxury ecosystem.
Yeah, so again, coming to consumers' discretion, actually, sports franchises in particular are very interesting. They're very unique. And it's very hard to actually find sport franchises that both you can invest in and also are profitable. Traditionally, actually, things like teams don't actually make a lot of money. Formula One is very interesting. Formula One has been around since 1950. And here what you're buying is an asset which was part of the Liberty Media Group, which was originally a tracking stock. And this is a new investment for us. We liked it because they converted it into an asset-owning operation. So the F1 Group basically has the right to manage the F1 Formula One racing brands around the world for a long-term commitment. They make their money in 3 ways. One is they host races. So cities around the world bid to host races for a number of period of time. There's 24 races every year. The race season runs from around March to December. They also make money from TV media rights. Depending on the numbers you look at, this is the 3rd or 4th most watched sport on the planet. Obviously, there's the famous F1 race in Montreal, but in the United States, it's really been in the last 3-5 years, they've expanded to add a total of 3 races. But outside of North America, this is phenomenal following. And the third area is sponsorships. If you remember when we were kids, most of the sponsorships you saw on F1 cars tended to be tobacco or car and auto parts and oil companies. Mm-hmm. Now the sponsorship has really expanded to include consumer brands all the way from LVMH to Google and other tech companies. And the viewership has also expanded globally as well. The other kicker here is, which is interesting, is that they also acquired MotoGP, which is almost the Formula One equivalent of two-wheel motorcycle racing. That became part of the group at the end of last year, represents about 10% of the revenue base. And we believe they're going to do similar things with how they expand that franchise going forward as part of this Formula One group. So again, we're looking at a business about 25 billion market capitalization, greater than 4 billion of revenues. And we think those 3 lines of drivers can drive consistent top line and earnings growth.
I got to admit, for me, car racing is watching paint dry, but it's one of those sports where when you know, I think, what's going on, you get much more pleasure out of it.
Andrew, can I recommend then watching a clip from MotoGP? If you think F1's a bit boring, MotoGP is faster, the overtaking is a little crazier, and the action and the camera angles are very interesting. So again, definitely worth watching. It's a fantastic franchise and again, sports franchises historically, when we look at these things, the value isn't just from the earnings side, but just the following in terms of eyeball and viewership.
That's interesting. So the motorbike racing, you reckon, has it might draw me in?
It might draw you in. When watch a couple of the races, you'll see what I mean.
That's right, yeah. I remember in my youth, they used to have that motorcycle race in the Isle of Man that was infamous. Poor guys would get smashed up doing it.
Yeah, so fortunately today, safety is coming quite nicely, so it's helping a lot. You've seen that on the Formula One cars, also MotoGP.
Yes.
But really what's very compelling here is just the global nature of the brand and the franchise's reach. We don't think is reflected in the current valuations.
Marcus Hansen, portfolio manager, Vontobel Asset Management. Here's how we ended the day on Bay Street and Wall Street. A reminder, TSX closing 188 points up, so 0.6%. That's another record close, 32,407, following yesterday's record close as well. The S&P 500, a 42-point gain, and the NASDAQ, 151 points up. That does it for the close. Thanks for joining us. We'll see you tomorrow.